Welcome back to the third accounting video dealing with acquisition of property, plant, and equipment. In this exercise, we're going to look at acquisition by way of a donation that someone just gave us the asset. Stock issuance, we issued stocks, but our stocks are not traded actively in the stock market. And when we self-construct assets and incur cost internally, how are we going to capitalize it? So we want to look at three different situations when we have acquired an asset or brought an asset into our books. So let's take a look at the example. Here we have a Duffner company. They have three separate situations. The first one is the city of Pebble Beach gave the company 5 acres of land as a plant site. The fair value of the land is estimated to be $81,000. So obviously this land is appraised and they've told us it's $81,000. This otherwise I would have paid cash, but I got this by way of a donation. The city has given this to me. This happens quite frequently when cities want to encourage businesses to come and start a factory or a business over there to create employment, create opportunities. So let's see how our journal entry would be structured over here. So I'm going to write the alphabet A instead of a date. I have acquired land, so that part is easy. Land is debited. I know the amount, it's $81,000. That part is also easy. The only question is, what should I credit? I have not given up any asset. I got something of value. So after much discussion, FASB has decided that the account you're going to credit is a revenue account. Previously, it used to be capital account, but basically bypassing the income statement. But FASB has now said that we are not allowed to bypass the income statement. We have to show this as a revenue. It affects the net income number, and then will flow into the equity section. So when we get something by way of a gift, it's going to be a revenue. Now let's look at the next situation. 13,000 shares of common stock with par value of 50 per share are issued in exchange for land and building. The property has been appraised with a fair value of $810,000, of which 180 is allocated to land and 630 is to the building. This is the appraised value. So this is a reliable number. Now the question is, do I know what I could have sold my stocks for in the open market as we had seen in the previous video? Let's continue reading. The stock of Duffner Company is not listed in any exchange, but a block of 100 shares was sold by a stockholder 12 months ago for $65 per share, and a block of 200 shares was sold by another stockholder 18 months ago at $58 per share. The question is, are either of these numbers reliable? They're reliable to the extent that it's a historical transaction. However, would my stock sell at more than less than 65 or 85, 58? I really don't know. What is more reliable in this case is the value of the property I'm getting. So in this case, I acquired two assets. I acquired land and building. I know the appraised value. So that's what I'm going to go with, the appraised value. So now what should I credit? I issued stocks. So I'm going to credit the common stock. I'm going to credit it at the 13,000 shares for 13,000 times 50. That's the par value. So this is the common stock par value. Now what did these two add up to? The 810,000. If this is the par value, the difference is in excess of par, $160,000. So basically what we're looking at over here is this is deemed to be the market value of my stock at this point of time based on the appraised value of these two assets. So once again, we are going with the more reliable numbers, something I can hang my hat up on if anyone questions me on this acquisition. Now let's take a look at the final case. No entry has been made to remove the accounts for materials, labor, and overheads, the amounts properly chargeable to plant asset accounts for machines constructed during the year. So during the year, I have self-constructed assets. I've incurred these expenses, but they have not yet been passed through. I have not yet charged the machine account, the machinery account. So I'm going to debit the account. Now I need to know what I should credit over here. So I have the machine account debit. So let me calculate the overheads over here. Okay, I have materials used, That's fairly easy. That's direct materials will get credited, 12,500. Factory supplies used. That's going to be an overhead. So that is used for this plant as this machine that I constructed. So let me see if there's any more. Labor cost incurred 15,000. That again I can put down over here 15,000. Okay, let's continue reading. Additional overheads over regular caused by construction of the machine, excluding factory supplies, which means I have more overheads, additional overheads of 2,700. Then I'm also told that the fixed overhead applied to regular machine manufacturing process is 60% of direct labor cost. So there's another cost over here, that's the applied overheads, 60% of labor. So 15,000 is my labor cost that has been assigned to this particular asset. So 60% of that is going to be $9,000. So the total amount that I have over here, 12,600, that's going to be the overhead, factory overhead that I'm going to apply to this particular asset. So the total cost assigned to the asset is going to be a combination of these three. So let me write that down here. It's going to be this number plus. So 40,100 is going to be capitalized, the materials, labor, and overhead to this particular project. So in this particular exercise, we've looked at acquiring an asset by way of a donation. Someone donated the asset to us. It's the city of Pebble Beach. In the second one, we acquired two assets. We know what the appraised value of the assets are. We gave up stock, but we don't know what the market value of our stock is at this point of time. So we go with the appraised value of that asset and the assets over there. And finally, in the third case, we have constructed a machine and costs have been incurred, and these costs need to be allocated to the machine that is being constructed. So this is a case of self-construction. So we've looked at three different examples where we acquire assets, and regardless of how the assets are acquired, we have to look at what is the correct way of allocating those costs to those assets, respective assets, because this now becomes a historical cost based on which we're going to charge depreciation moving forward. So this concludes the series of acquisition of assets. The next one we're going to look at is going to be when we have a zero interest bearing note. So this is dealing more with the financing aspect of acquisition, but we will go over that in detail. So that's going to be our next lecture.